Hello and welcome to Chapter 13, Investing in Mutual Funds, ETFs, and Real Estate. Learning objectives describe the basic features and operating characteristics of mutual funds and exchange-traded funds. Differentiate between open and closed-end mutual funds as well as exchange-traded funds and discuss the various types of funds, fund loads, and charges. Discuss the types of funds available to investors and the different kinds of investors, services offered by mutual funds and exchange-traded funds. Gain an understanding of variables that should be considered when selecting funds for investment purposes. Identify the sources of return and calculate the rate of return earned on an investment in a mutual fund, as well as evaluate the performance of an exchange-traded fund. Understand the role that real estate plays in a diversified investment portfolio, along with the basics of investing in real estate either directly or indirectly. How will it affect me? If I can get there we go. Having a financial plan and being aware that diversification is crucial is a great start to the task of investment planning. The next step is figuring out how to implement your plan by deciding what to invest in. For most people, diversification is best achieved using mutual funds and exchange-traded funds, ETFs. This chapter describes the key characteristics of each type of fund, sorts through the various options you have, shows how to calculate rates of return and evaluate performance, and explains how to choose among funds. The essential elements of investing in real estate and its role in diversifying your overall investment portfolio are also covered. After reading this chapter, you should be in a good position to invest in mutual funds, ETFs, and real estate in a way that will help you achieve your financial objectives. Basics. Mutual fund is a financial service organization that receives money from its shareholders and invests those funds in their behalf in a diversified portfolio of securities. Exchange traded fund, ETF. Excuse me. An investment company whose shares trade on stock exchanges. Unlike mutual funds, ETF shares can be bought or sold short. That's an option. It's called option tradings. Throughout the day, ETFs are usually structured as an index fund so that it's set up to match the performance of a certain market segment. Like a mutual fund allows investors to achieve diversification through professional management funds. Okay, so an example of the ETF, if I can find what here. Okay, so if we go back to this, okay, and we go to one of those ETFs, which let's just look at QQQ. Okay, so that's based on the NASDAQ. So this is a portfolio of stocks from the NASDAQ. And so as the NASDAQ goes up, this ETF goes up. And as the NASDAQ goes down, this goes down as well. So you can see. So it pretty much tracks the same as the NASDAQ in general. But it's not just one stock, it's a basket of stocks from the NASDAQ. So if you just want to invest in one stock in the NASDAQ, it's not diversified. That one stock may go up or down. But if you think that the NASDAQ as a whole is going to go up, then you could invest in this and it would then track the NASDAQ's progression. Okay? Now, unfortunately, it does go down when the NASDAQ goes down, but as you can see, if you go all the way back to the Great Recession, which is right here, okay, it was at 29.61. It was the close. Okay, the low was 24.94. Okay? So if you'd have bought it then in the 20s, today it's 281. So you would have gotten 10 times your money back. Okay, your investment would have increased by 10 times in the past, what is that, 12 years. So over a 12-year time period, your money would have increased by 10 times from what you had back in 2008. 2008, 2009. What is this here? Yeah, 2008 is when that was. Okay, so there you go. Okay, now if you invested here though, okay, so right there, this is, um, there's the peak. So this is $109 back on December of 1999. Okay, so if you'd invested there over the next 8 years, you would have lost 70% of your money. Okay, so it all depends on where you start and where you stop. At this point in time, it looks like this is similar to this. Okay, so again, nobody can tell the future. You know, you may want to wait until it has a correction and gets down to here again before purchasing it. So you don't capture it at the peak, you're closer to the bottom. And again, you just treaded water for a while and then it went up. Okay, so it could go down like it did before and then tread water for a while and then go up. We don't know. Can't tell the future. Okay, but you want to buy low and sell high, and it looks like we're pretty much at a high here. Now, it doesn't mean it can't go up more. It might go up to 300. We don't know. Um, we just know what the trend has been, that when it's gotten so high, it's fallen and then gradually went back up. Okay. So that's just food for thought. You do what you like. If you think it's going to drop, you can always buy puts, which is called shorting the market, and that's betting that it's going to drop. Those are very high risk, and we can talk about that at another time. But that's another way of investing. Anyway, let's move on then. Mutual funds. There are many mutual funds, 9,500 by 2017, with total investments of $18.7 trillion. Trillion dollars. Okay? Professional money managers select stocks and manage portfolios. Dividends, interest, and capital gains earned by mutual funds are passed through to the investors, who are subject to taxes on the income even though they have not received the funds. So you're subject to the taxes, unlike stocks, where you're not subject to the taxes unless you sell the stock. With mutual funds, you're subject to the taxes. Why invest in mutual funds? Well, it's pool diversification process why investors buy into a diversified portfolio of securities for collective benefit of the individual investors. You have professional management, which is full-time expert managers search for the best investments. Financial returns, investors hope the mutual funds will achieve higher returns than they can generate on their own because they're supposed to know what they're doing. Convenience, easy to purchase mutual funds, and the funds handles all of the tax reporting and record keeping, but investor has no control over buying or selling the securities. Plus, you have huge fees you have to pay because as professional investors make money whether you do or not. Okay? How mutual funds are organized and run. Each mutual fund is a separate organization owned by shareholders but controlled by fund managers. Management company runs daily operations. Investment advisor oversees the portfolio. Distributor sells fund shares. Custodian safeguards fund assets. Transfer agent executes it, blah, blah, blah. All may be affiliated companies, such as Fidelity. Fidelity is a huge mutual fund company. Open end versus closed end. Open end, commonly called mutual funds, shares are purchased from and sold back to the company. New shares issued as money flows in. Net asset value at the end of the day is the quoted price. Closed end investment companies have fixed number of shares. Trading between investors in open markets, so fund does not have to plan to have cash for redemptions. Do not have new money coming into the fund, so focus is on managing a portfolio of stocks. Shares are listed and traded at a discount or premium to the NAV. Okay. And then net asset value, NAV, total market value of all securities held in the fund's portfolio less liabilities divided by number of shares outstanding. They'll fluctuate in value, only determined at the end of the trading day, and quoted price for the next day. Okay. So you have the exchange traded funds, which is what I just told you. These are the spiders. I showed you the QQQ, which is the NASDAQ spider. S&P 500 is SPY. So if we go back here and look at SPY, search SPY. So this is the S&P 500 ETF, and you can see it tracks the same thing. Back here, COVID, it was at 222, and today we are at 339.48. So from 222 to 339, so that's $117. So you basically increased the value. If you bought it on March 22nd, you increased the value by 50%. So if you went in and bought SPY back on March 22nd, you put $10,000 in it, that $10,000 today would be worth $15,000. Unfortunately, if you put $10,000 in it there, 338, today it would be worth $1 more. So what is that, 10, 20, 30? So you'd have $30 more today than you did back in February 18th of this year, investing $10,000. So again, it depends on where you're buying it, at what point in time you're buying it, as to what your return is on this ETF. Okay, and next, there's the symbols. We already went through that. Bond funds, government bond funds, which we talked about many times. If you go to the markets and go to the bonds, and there's your bond funds. Okay, so if you buy a 1-year U.S. government bond, oh my goodness. There you go. 1-year U.S. government bond, you'll make 0.127% on it. 0.127%. So that means for every $10, that right? No, for every $100, you get 12 cents. Something like that. Yeah. So that's a good return, right? And for a 30-year one, you get 1.34%. So for every $100, you get $1.34 for that one. A year. That's per year. That's your income off of your $100. Of course, inflation is $2.50 per every $100. So you're losing about $1.16 every year for inflation. Okay? So that's your bond fund. Mortgage-backed bonds, those are what crashed in the Great Recession of 2008 because no one was paying back their mortgages. They just stopped paying. And because the value of the houses dropped in half or more. High-grade corporate bonds rated triple B or better. Then you have high-yield corporate bonds, which are also called junk bonds, which are C. They're rated C's. And then convertible bonds, municipal bonds, and immediate bonds. I'd like to talk more about it, but that's the end of the time we have for this chapter. Only one more chapter to go.